Net present value, internal rate of return, payback period, discounted payback period are critical methods of evaluating businesses or projects that we want to embark on. This touched on an important aspect of investment and business life. Whether you are an investor, whether you are an accountant, whether you're an entrepreneur, all these methods have their advantages and disadvantages. Let's take an example. Discounted payback period is not a replacement or a substitute for net present value calculation and you ensuring that internal rate of return is equally checked before you embark on a project. So we are going to take them one after the other so that we understand them without wasting our time. This is GJAMES Associates. We pride ourselves that we are value to life, we are value to your businesses. If you enjoy value, don't forget to like and click the subscribe button. Having said that, what is net present value? When we are talking about this and even all of the methods, time is a big factor. Cash flow is a fact, and profitability of your organization or project is just your opinion. So, all these must be factored into whatsoever you are doing to establish whether you should go for it or you should not go for it in your business. Net present value approach actually approach from the standpoint of, will this project add value now? Should I come again slowly? Would the project you want to embark on have value now? The present value. Don't forget, time is a factor. Don't forget, when we are calculating present value, time is a factor. When we are calculating future value, time is a factor. We are not going into that because I have a video already on that which you can check on my channel. So net present value shows you what you need to know about the value of the inflow and against the outflow of the project you want to execute in form of profitability. Like I said, your profitability is simply an opinion, but the cash flow is a fact and king on the document that you are working on. Having said that, you also need to know the internal rate of return and compare it to what the net present value is giving you, especially because internal rate of return is building on the net present value to ensure that if at all the rates of profitability and of the investment becomes zero, it helps to assess the potential of the return, whether to go for the investment or not. Payback period is a bit simpler because it measures and will give you whether to go for the project or not based on how many years it's going to take you to get your initial capital back. The payback period measures the time it takes for an investment to repay the initial cost, that is the capital. Please don't take the cost for cost of capital. They are two different things. Last but not the least, you need to check your discounted payback period, which simply relies on project or not based on how many years it's going to take you to get your initial capital back. The payback period measures the time it takes for an investment to repay the initial cost, that is the capital. Please don't take the cost for cost of capital. They are two different things. Last but not the least, you need to check your discounted payback period, which simply relies on which simply relies on calculating how fast the investment can give you back your money. Once you are able to get that, it forgets about the other inflows that may later come. That is the approach. Everything I've said is based on simple layman understanding so that we can be grafted into. This is not complicated. If you would like me to pick this one after the other and calculate it, please let me know. Net present value, internal rate of return, payback period, discounted payback period are critical methods of evaluating businesses or projects that we want to embark on.